Okay, let's unpack this one. Imagine a company, right? It's playing in one of the absolute hottest markets going ESG, red tech. They've even got testimonials from huge names like Coca-Cola.
That's amazing. Yeah,
Sounds like a winner on paper.
exactly. But then picture this. The very same company reporting massive financial losses. Their liabilities are actually more than their assets, so we're talking negative equity. And the stock price, it's all over the place. It can double or halve, sometimes in just weeks.
That's quite the contrast, a real high-wire act.
It really is.
Mm.
And that stark, high-stakes picture is exactly what we're diving into today. We're looking at DGNX Limited. The ticker is DGNX, a company right in the middle of that environmental, social governance, ESG, and regulatory technology space.
Right. And our mission here, for you listening, is to take this pile of sources, analysis reports, the financial statements, news releases, all fresh as of early June 2025, and really try to cut through the noise.
Make sense of it all. Yeah, help you understand what's actually going on with DGNX. We'll be looking at it kind of like the sources suggest, through that value investor lens. Think Warren Buffett style, looking beyond the market hype.
Seeing the business for what it is based on the data?
Exactly. The underlying business, the financial reality, what the numbers are telling us.
Especially when the story and the numbers seem to pull in opposite directions. We've got all the material here to try and piece together that clearer picture for you.
Yeah, we'll look at their core business, where management's trying to take them, and then, crucially, dive into those financials. The income statement, balance sheet, cash flow. What do they really say?
We'll also hit the risks, obviously. How can a company be in such a hot market but look so, shaky financially?
It's a fascinating puzzle.
It is. Oh, and a quick note, if you enjoy this kind of deep dive, getting into the weeds on specific tickers, please do like and subscribe to Stock Analytics AI. For just Euro 4.99 a month, members can actually give us a ticker, and we'll prioritize doing a deep dive analysis just like this one for you.
Definitely worth checking out if you like this kind of breakdown.
All right, let's get into this first half. Who is DGNX Limited, and what are those numbers really saying?
Okay, so DGNX Limited, DGNX. The sources describe it as a reg tech company. And interestingly, they just moved their headquarters from Hong Kong to London. That happened earlier this year, 2025.
London.
Yeah.
That's a statement in itself, isn't it? Planting a flag in a major financial center. But what do they actually do? What problem are they solving?
Well, their stated mission is all about helping businesses and governments, too, get a handle on all this complex data around ESG, climate change, supply chains, making reporting easier, more transparent, more actionable.
Using tech to do that.
Exactly. They talk about using blockchain, AI, machine learning to power their solutions.
Okay, and the sources mentioned some specific products they offer.
Yeah, there's a whole suite. The main one seems to be DGNX ESG. That's their cloud platform. Apparently, it supports like 17 different reporting frameworks. Big ones like GRI, SAB, TCFD, and the new ISSB standards, too.
That's pretty comprehensive.
It seems so. Then they have DGNX Lumen, which focuses on supply chain risk, DGNX Apprise for worker engagement. And they also offer advisory services, DGNX Advisory, even a service specifically to help companies boost their ESG ratings.
And we saw this testimonials mentioned earlier, Coca-Cola in Specs Group. That does add a bit of weight, suggests some real-world traction.
It definitely suggests interest, maybe some early wins, but you have to see this against the industry backdrop. They are swimming in markets that are just exploding right now.
Right, the growth numbers are pretty wild.
Yeah, the sources quote things like the U.S. ESG reporting software market growing at, 15.2% NGR? The global ESG software market hitting maybe $54 billion by 2035? Sustainability platforms overall seeing like 23% compound annual growth.
It really does feel like that gold rush description someone used.
Yeah.
It's driven by regulations piling up, the EU's CSRD, those SEC proposals in the U.S., plus investors are just demanding this data now.
Totally. And the broader RegTech market they play in. Also, huge growth forecast, maybe over $80 billion by 2033. So, yeah, the wind is definitely at their back in terms of market trends.
But Old Rush brings everyone out digging. Who are they actually competing against? It sounds crowded.
Oh, it is. Very crowded. You've got specialized players, sure, but the sources really highlight the big guys moving in, too. Think NASDAQ, Workiva, SAP, Microsoft, companies with deep pockets, existing customer bases, and they can just bolt ESG features onto their current software.
Okay, so how does a smaller company like DGNX try to carve out its space? What's their edge, their moat, as they say?
Well, the sources suggest they're banking on a few things. Their tech focus, especially pushing the AI angle, maybe using blockchain for transparency. Strategic partnerships seem key to working with accounting firms, advisory groups to reach clients.
Kind of a channel strategy?
Right. They might be trying to be a first mover in really comprehensive AI-driven solutions. And then there's that big Abu Dhabi investment we need to talk about later that could give them a real leg up in the Middle East, the GCC region.
But the sources also mention that just having cloud software isn't enough anymore. Building a real moat takes deep integration, proving you deliver real value again and again. That's the hard part.
Absolutely. And that brings us to their business model, mostly SaaS subscriptions, which is great for scaling if you get the scale. But the sources point out this huge disconnect between their global ambitions, these big partnerships, and their actual size right now.
Yeah, the employee number jumped out at me, something like 19 or 22 people.
Yeah, incredibly lean for a company with a London HQ, listings in Frankfurt, aiming for Abu Dhabi, presence in the US and Hong Kong. It's a global footprint on paper, but a tiny team running it.
And the revenue figures really drive home that scale gap, don't they?
Oh, massively. Trailing 12 months revenue, ending last September 24, was just $1.18 million. And here's the kicker. For their full fiscal year ending March 2024, revenue was actually down. It was $1.3 million, but that was a 20% drop from the year before.
Wait, a decline. Revenue went down 20% year over year in a market supposedly growing at 15–20% plus.
Exactly.
That feels like a major warning sign even before we talk profit.
It's a huge disconnect.
Yeah.
It suggests, they're just not grabbing that market growth. Maybe customer churn is high, maybe sales aren't landing. Whatever the reason, it's a problem. And then you put that tiny $1.18 million TTM revenue next to their market cap, which has been bouncing between $1 and $1.5 billion.
Billion with a B.
Billion with a B. The price to sales ratio is just astronomical. Some calculations in the sources put it over 1,000 times revenue.
1,000 times. Okay, that's not based on reality right now. That's purely betting on some massive, massive future growth that just hasn't happened yet.
Precisely. It's the definition of a story stock. The valuation is all about the narrative, the future potential in this hot sector, not the cold, hard financial facts of today.
Okay, let's shift gears slightly. Who's actually running this company? Who's making the calls?
Well, the main leaders mentioned are CEO Mark Blick and the chairman and founder Miles Pelham. Mark Blick's background is apparently in scaling up services and platforms, like at Gerson Lerman Group.
Okay, operational focus.
Right. And Miles Pelham comes from high-level finance, trading, managing big operations at global banks. So you've got that finance and funding expertise there.
Kind of a complementary pairing.
Seems like it. And the sources also flagged some key hires they made this year, 2025. A global chief commercial officer came from S&P Global, and a lead strategic advisor for M&A, ex-private banking.
Ah, M&A advisor. That signals intent, doesn't it? Aggressive expansion, maybe buying growth.
Yeah, if it looks that way. These hires suggest they're gearing up for some serious moves, likely using acquisitions to build scale and capability fast.
And their actions since the IPO this year certainly back that up. They haven't been sitting still.
No, not at all. The IPO itself in January brought in about $9.2 million, some initial fuel. Then they did the HQ move to London, listed in Frankfurt too, trying to get more European visibility, I suppose. But the really big moves came in May 2025.
Right, the Abu Dhabi investment first. Tell us about that.
Yeah, this looks potentially huge. According to the sources, His Highness Sheikh Mohammed bin Al-Hassan bin Hamdan Al Nahyan acquired warrants. If he exercises all of them, it could mean a serious cash injection, potentially around $69 million for DGNX.
Wow, $69 million.
Yeah. And it was tied into this broader strategic alliance with a group called Nomos Global. Plans mentioned include maybe listing on the Abu Dhabi exchange and potentially raising another $250 million, $250 million by the end of 2025.
Okay, that $250 million sounds more speculative, though.
Oh, yeah. The sources stress that part is very much contingent, uncertain. But the $69 million from the warrants seems more concrete, though still potential until exercised. Still, it's a massive potential boost and a powerful strategic partner.
Definitely a potential game changer. And the other big news in May was acquiring that Danish company, Matter DK.
Correct. They signed an MOU, a Memorandum of Understanding, to buy Matter DK APS. It's an ESG data analytics firm based in Denmark. The price tag mentioned is $13 million, but it's an all-share deal.
All shares, so diluting existing shareholders.
Yes, that's the implication. An interesting side note from the sources, NASDAQ was apparently the biggest shareholder in Matter DK. The idea is to integrate Matter's AI and data analytics smarts into the main DGNX ESG platform.
Okay, so the strategy is pretty clear then. Get cash, build powerful alliances, buy technology, and maybe customers to grow super fast.
It's definitely a multi-pronged attack. They're explicitly trying to scale up incredibly quickly to grab a piece of this booming market.
But running multiple plays like that, especially for a company that's currently so small,
Hmm.
what are the big risks the sources point out?
Well, several big ones. First, they are massively dependent on actually getting that external money. The full $69 million plus from the warrants needs to come through. That potential $250 billion is still just potential. Then there's the dilution. The all-share matter DK deal waters down existing shares, and so will exercising those warrants.
Right.
And just the sheer complexity, trying to integrate an acquisition, push for global growth, manage all these partnerships, all at the same time. With that tiny team we mentioned, the execution risk is enormous.
It really does sound like they're walking a tightrope, which brings us perfectly to the financial health part. Let's look past the strategy buzz and see what the actual books look like.
Okay, financials as of early June 2025. First off, just look at the stock price action itself. It tells the story. Since the IPO low of $3.60, it went absolutely nuts, hitting $155 at one point. Even just in May 2025, the sources said it swung from maybe $55 up over $100, and then boom, fell back sharply into early June, landing in the mid-40s, low $50.
That kind of wild ride isn't just market noise. It screams uncertainty, speculation. That billion to billion and a half market cap is bouncing around like crazy.
It really is. Okay, let's dive into the income statement. We're using the trailing 12 months data ending September 2024 from the sources. We already mentioned that tiny $1.18 million revenue number.
And the gross profit was the same, right? $1.18 million. That 100% gross margin you see with pure software.
Correct. Once the software is built, the cost to deliver one more copy is basically zero. So, yeah, 100% gross margin isn't unusual initially.
But that's just the cost of the software itself. What about running the whole show? The offices, the sales team, R&D?
And that's where the picture gets ugly, financially speaking. Operating expenses for that TTM period, a huge $9.7 million. And the vast majority of that, like $9.110 million, was SG&A selling, general, and admin costs.
So even with a perfect gross margin, the day-to-day running costs are just swallowing all the revenue and much, much more.
Way more. It led to a TTM operating loss of $8.52 million. The net loss was $6.9 million. Consequently, their earnings per share was negative, minus 85 cents. EBITDA, also negative. The takeaway is crystal clear. Their costs are way out of line with current revenue. They're losing a lot of money.
Okay, let's turn to the balance sheet. Same period, TTM September 24 from the sources. What's the foundation look like? Assets versus liabilities.
This is where it looks, frankly, quite alarming from a traditional viewpoint.
Yeah.
Total assets were minuscule, just $1.07 million, but total liabilities, $16.91 million.
Oh, liabilities are almost 17 times their assets.
Which leads directly to the really critical point, negative shareholders' equity of minus $15.85 million.
Negative equity. Explain what that means for people listening.
It means the company's accumulated losses over time have completely wiped out all the capital shareholders ever put in, and their debts are now significantly higher than the book value of everything the company owns. The sources literally say, on a book value basis, they are technically insolvent.
That negative equity is a massive red flag for anyone looking at financial strength in the usual way.
It's a sign of extreme financial fragility. The balance sheet also showed high debt, $14.52 million. And maybe most critically, their cash was incredibly low. At the end of their fiscal year, March 2024, the sources said they had just $76,620 in cash. TTM ending Sep 24 was $4.1 million, so $100,000.
$76,000 in cash. For a company talking about global expansion and acquisitions, that sounds almost impossible.
It was dangerously low, based on those last reported figures before the IPO and these recent funding announcements. It just hammers home how utterly dependent they are on getting that outside cash, not just for growth, but just to keep the lights on.
And their working capital was negative too, meaning they couldn't cover short-term bills.
Deeply negative, yeah. Current assets didn't come close to covering current liabilities, and their book value per share was also negative, minus $1.07, just confirming that insolvency picture on paper.
Okay, so the balance sheet paints a picture of a company technically underwater. Its survival hinges completely on raising outside money.
That's the unavoidable conclusion from the balance sheet data in the sources.
All right, what about cash flow? Are they actually generating any cash from selling their software?
No. The cash flow statement for fiscal year 2024, detailed in the sources, shows cash flow from operations was negative $5.86 million. So the core business itself burns through cash, doesn't generate it.
Okay, minimal capital spending, you said. Asset light model.
Right, very little capex.
So where did any cash inflow come from then?
Pretty much entirely from financing activities. Cash flow from financing was positive, about $4.75 million in FY24. That means taking on debt or issuing shares. But even with that, the net result over the year was their cash balance went down, ending at that critically low 76K figure.
And free cash flow, the cash left after operations and investments.
Significantly negative, about minus $5.86 million in FY24 and minus $6.8 million TTM. The sources even did a rough calculation showing basically 0 months of runway based on that SCF before the new capital came in.
Wow. That really puts the financing dependency in perspective. It wasn't just for growth, it was for survival.
Absolutely. The cash flow statement confirms it. A business model burning cash heavily, needing constant external fuel just to operate.
So if you pull all these financial ratios together, the income statement, balance sheet, cash flow, what's the final verdict from the numbers?
From a traditional fundamental standpoint, it's a picture of severe financial distress. Negative EPS, PE is meaningless. You've got that absolutely crazy price-to-sales ratio over 1,000x, signaling pure speculation. Current and quick ratios are dangerously low, like 0.07, meaning terrible short-term liquidity. And the margins, operating in net, are deeply negative.
Not a healthy picture.
Not at all. These ratios reflect a very early-stage company, maybe even pre-revenue stage in terms of financial health, but with a valuation completely based on future hope, not present reality.
And dividends, I assume, are non-existent.
Correct, no dividends, as you'd expect from a company losing money like this. Any return for shareholders has to come purely from the stock price going up, which depends entirely on them pulling off this huge turnaround and growth story.
Okay, that wraps up a pretty sobering look at the financials in the first half. Before we get into market sentiment, risks, and the value investing angle, just a reminder, subscribe to Stock Analytics AI for more deep dives like this one. All right, moving into the second half. Let's connect those really challenging financials we just laid out with how the market is actually feeling about this company and how it's being valued.
Yeah, we keep coming back to that valuation disconnect, but it's central here. You've got a market cap floating around $1 zillion, maybe $1.5 billion, against just $1.18 million in trailing revenue.
Yeah. That 1,000+ price to sales ratio. It's just so far removed from normal ranges, especially for a company whose revenue recently declined. What does that valuation actually tell us about market perception?
It tells us the market is buying the story, pure and simple. The potential in the ES-grade tech space is huge. Everyone agrees on that. The market seems to be valuing that potential. And the narrative around DGNX's strategy, the Abu Dhabi link, the Matter DK deal, much more than its current performance.
It's a bet on the future, ignoring the present problems.
Completely. It's ignoring the negative earnings, the negative equity, the cash burn. It's all focused on the hope of exponential growth down the road. That's why it's a story stock.
Is anyone actually covering this professionally, like Wall Street analysts putting out research reports and price targets?
The sources suggest coverage is very thin, maybe even non-existent. That lack of independent analysis just adds to the speculative feel. Without professional models out there, the price is even more easily swayed by news, hype, and just trading momentum.
Which explains the wild volatility we saw.
Exactly. And the sources also mentioned some short interest, meaning there are definitely traders betting the price will go down.
Okay, who actually owns the stock right now? Is it big pension funds, mutual funds?
No. According to the sources, institutional ownership is incredibly low, like 0.3%. That tells you the big conservative money managers are likely staying away for now.
Waiting for proof.
Probably waiting for financial stability, a clearer path to profit, something more tangible. Most of the ownership seems to be with insiders and private groups. Names like Rhino Ventures, HBMIV were mentioned, holding significant chunks. And then there's the potential big new shareholder. That Abu Dhabi stake, if the warrants get exercised, would be around 22.7%. That would be a major strategic holder.
So mostly insiders, private funds, and presumably a lot of retail speculators given the volatility. This whole picture looks really different when you put on that value investing hat, the Warren Buffett approach.
Oh, completely different. A core idea for value investors is owner earnings, basically. How much real cash does the business generate for its owners over time? For DGNX, right now, with negative profits and burning cash, owner earnings are deeply negative.
So it fails that fundamental test right out of the gate. It's not currently generating cash for owners.
Not even close. Investing in DGNX today, from that perspective, isn't buying current value. It's placing a very speculative, high-conviction bet that maybe, years down the line, it could generate huge owner earnings. assuming everything goes perfectly.
And trying to value it using standard things like price to earnings or price to book.
Forget it. As we said, PE is useless with losses. PB is useless with negative equity. The current stock price has absolutely no connection to those traditional anchors. It's floating entirely on that narrative of future growth.
Which leads to the idea of margin of safety, Buffett's rule. Buy something for way less than it's worth so you have a cushion if things go wrong. Does DGNX offer any margin of safety based on these sources?
Based on the financials presented here, the negative equity, the cash burn, the lack of profits, there's zero traditional margin of safety. You're not buying assets cheap. You're not buying earnings cheap. You're paying a massive premium based purely on hope.
So it's a high-risk gamble, not a value investment.
Absolutely. It's a wager that future growth will be so explosive, it overcomes all the current problems and justifies today's sky-high price. That requires an enormous appetite for risk and the real possibility of losing your investment.
Okay, so if it's not a traditional value play, let's really consolidate the risks we've touched on throughout this discussion. What are the main buckets of risk here?
We can group them, like you said. Financial risks are huge.
Yeah.
The ongoing losses in cash burn, that negative equity is critical, the liquidity risk from low cash before recent funding, the absolute dependence on getting that external financing through, the high debt, the insane valuation risk with that PS ratio, and the dilution risk for current shareholders from deals and warrants.
That's a long list on the financial side alone. What about actually doing what they say they'll do? Operational risks.
Big ones there, too. Successfully integrating matter decay, the tech, the people, and that's never easy. Can they actually execute this complex global strategy, M&A, expansion, partnerships, all at once with such a small team? And crucially, can they generate the massive revenue growth they need, especially when revenue just declined 20%?
Plus the competition.
Intense competition. Over 200 vendors, the sources say, including those tech giants with huge resources. And are their products really mature and being widely adopted yet? The low revenues suggest maybe not. Plus, they rely heavily on partners to bring in business.
So even with the market tailwinds, actually catching that wind is a huge challenge, internally and externally.
For sure. Then you have market risks. The stock price could tank if sentiment sours on tech or ESG. An economic slowdown could hurt client budgets, and the volatility itself is a risk.
And any specific regulatory risks? The ESG rules are still changing.
Yeah, while regulation drives demand, the constant changes create uncertainty. They support lots of frameworks, which helps, but they still need to adapt. Plus, just the compliance burden of being listed internationally.
It really does feel like that make-or-break description from the sources is accurate, looking at all these risks piled up.
It's a critical phase, no doubt.
Okay, as we head towards wrapping up, we're going to connect this whole high-risk, high-reward situation to something that might seem unrelated at first glance. Recent U.S. tariff changes. How could that possibly factor in? Stay with us for the final thoughts.
Right. Let's just briefly touch on those 2025 U.S. tariffs mentioned in the sources. How might they impact DGNX, even indirectly?
Yeah, it seems odd. They sell software, right? Not steel or cars.
Exactly. So directly. Probably minimal impact on DGNX's own costs. They're not importing physical goods that get taxed.
Okay, so it's the indirect ripple effects we need to think about.
Potentially, yeah. Mostly through their customers or potential customers and just the general economic climate. The sources note these tariffs hit industries like manufacturing, automotive, some tech sectors.
Ah, okay. And those are exactly the kinds of companies that might buy ESG or supply chain software from DGNX.
Precisely. So if those companies get squeezed by tariffs, higher costs, maybe lower sales, supply chain headaches,
They might tighten their belts, cut spending.
it's possible. Financial pressure could make them delay or scrap spending on new software, even if that software, like DGNX's, could maybe help them manage supply chain risks in the long run. Immediate cost cutting often wins out.
And tariffs can just add to overall economic uncertainty too, right? Make everyone a bit more cautious.
Definitely. A weaker global economy generally means less corporate investment, maybe including sustainability initiatives. So while, yes, more supply chain complexity could theoretically boost demand for a tool like DGNX Lumen, the horses suggest the benefit might be outweighed if clients are just struggling financially.
So it's an indirect hit through potential client budget cuts in affected industries and just a more uncertain economic backdrop, another layer of risk to consider.
It is. For some companies hit by tariffs, maybe DGNX looks more attractive to manage the chaos. But for others, the immediate financial pain might be too much. It adds uncertainty.
Okay, let's pull this all together then. Let's wrap up with a conclusion, looking back through that value investing framework.
Sure. So from a traditional value perspective, DGNX Limited, based on everything in these sources, looks like a highly speculative situation. Yes, they're in a fantastic growing market. Yes, management has an aggressive plan with some potentially powerful backing.
But critically, the company right now is deeply unprofitable. It's burning through cash at a high rate, it has negative shareholder equity, and its actual survival, let alone growth, seems entirely dependent on getting that external funding to come through.
That's the crux of it. The business model just isn't proven at scale yet. Revenue is tiny and it even went backwards recently. And that valuation. But price to sales over 1,000. It's completely untethered from today's financial reality. It's all priced on a future miracle, basically.
And because of all that, there's no traditional margin of safety, no cushion if things go wrong.
None whatsoever. Investing in DGNX today isn't value investing. It's pure speculation. It's a bet that hinges on almost perfect execution of a very complex strategy, integrating matter decay smoothly, getting and using that Abu Dhabi money effectively, achieving incredibly fast, profitable growth against tough competition.
So it's definitely not a stock for the conservative value investor.
Absolutely not. It's high risk, maybe high reward, but it demands an investor who can stomach extreme volatility and the very real chance of losing a significant amount, maybe all, of their capital.
Which loops us right back to that initial puzzle, doesn't it? How can a company in such a hot sector with big names interested look so financially precarious and have such a wild stock chart?
Because the potential is so enticing. The market opportunity, the strategic narrative, the Abu Dhabi connection, it's enough to attract speculators and strategic partners willing to take a gamble. But that compelling story runs headlong into the harsh reality of the current financials. The negative equity, the cash burn, the tiny revenue.
It's a race against time then.
It feels like it. Can they execute fast enough, turn that potential into real profitable scale before the money runs out or the market loses faith? Can they bridge that massive gap between the story and the current numbers to eventually justify that huge valuation? That's the multi-billion-dollar question.
So here's a final thought for you, the listener, to chew on based on all this. In a world where ESG demands and regulations are exploding, can a company like DGNX, with seemingly good tech and strong backing, actually overcome these severe financial hurdles and scale up fast enough? Or will the cash burn, the competition, the execution challenges just prove too much before that potential dream becomes reality?
That really is the fundamental question here, looking at all this data.
If this deep dive helped you think through that question, please remember to subscribe to Stock Analytics AI on YouTube. We do more analysis like this all the time.
And just a standard reminder, this discussion is purely for informational and educational purposes. It is definitely not financial advice. Stock Analytics AI uses AI and public data, but we can't guarantee accuracy or completeness. All investing involves risk. Please, always do your own homework and talk to a qualified financial advisor before making any investment decisions. You can find links to the sources we use down in the description.
Thanks for joining us for this deep dive. We'll catch you on the next one.